good evening, everybody, and welcome to our May Multifamily Women's Mastermind Zoom meeting. Tonight, we have a very special guest with us, Anna Myers, which I'm super excited to hear from because she focuses on underwriting and asset management, which I also enjoy, so I'm excited. I'll tell you a little bit more about her. I'm sure all of you on the call probably already know about Anna, but just in case, someone doesn't, I'll tell you a few high points. She serves as Vice President of Grow Capitus, which is based in San Francisco, Bay Area. She's a third generation commercial real estate investor with 25 plus years of experience in tech and business. Her business partner is Neil Bawa, which I'm sure most of you know as well. They approach real estate from a data science lens, very data driven. And they use that expertise to create profits for over 2,000 investors so far, and I'm sure it's growing by the day. Anna is the lead underwriter and asset manager for the Grow Capitus portfolio, and they have raised over $50 million so far for multifamily, mixed use, and self-storage now as well. And they have over 2,000 units, is that right, Anna, so far? And I'm sure that's about to be growing rapidly as well.
Yeah, that's growing. And actually it's actually 53 million. Now we just did another raise in the middle of the pandemic and sure enough, went great. So I'll talk about that too. Like, how do you raise money in a pandemic?
Yeah, definitely want to hear about that. I know you have a lot of experience in the capital raise space as well. So tonight, Anna will be talking to us about asset management, especially in the times of Corona, and the type of properties or projects we should be looking at in these uncertain times. So Anna, I'll go ahead and let you present. And then after you present, I have a few questions prepared that we can go over in a town hall type style. And then after that, we'll open up for anyone to ask questions. So Anna, over to you.
Awesome. Somebody's already got a chat going. So how I got started, if the session allows. So sure, I'll give a little brief intro when I get to my slide. Since Candace already read a lot of my bio, when I get to like my bio slide, I'll give you like the woman's version of my background. So we are going to be talking about asset management from a process and data geek. Yes, that's me. I'm a total data geek and I obsess over systems and processes. So here we go. So Candace gave me a great little intro. So this information kind of has already been covered. So I'm going to give you the quick story of how I got here, where I am now. A third generation commercial real estate. My grandfather was a commercial real estate entrepreneur in Los Angeles in Southern California. I'm the youngest of 16 grandchildren, and I actually didn't go into commercial real estate. Being the youngest, everybody else was doing it in the family. I went into, so I've always been interested in art and science. My parents never knew what I was going to do. They were like, are you going to be an artist? Are you going to be a mathematician? Like, what's it going to be? And I said, I don't know. I really wanted to be a photographer. So I'm a very artistic person. So I was actually a stage actress growing up in LA. So as a child, I was a stage actress. So I wanted to be an actress and a photographer. But what happened is I ended up having a baby as a teenager. I was a single parent, and I was actually in my first year of UC Berkeley. I was 17 at the time, or 18 when I had the baby. And so I couldn't do that. So I took some time off from school to figure myself out, went back to school and started programming. So in order to raise money and have money as a single parent for my child, I became a programmer. And turns out, again, kind of that science side of me, I really enjoyed it. I was good at it. And so I had a career in tech for 18 or 20 years. That child grew during that time, obviously. I also ended up getting married when she was about 12 and had another child. So I have two daughters that are my biological daughters. I have 4 step daughters. So 6 kids, large blended family. About 2000, the tech industry crashed, for those of you that remember that time frame. And I was like, and I was at the top of the, I was, working with the executive levels, systems architect, creating big portals, traveling all over the place, speaking at big conferences. And I was like, I am not working for the amount of money that they're offering me. So what I did at that time is I pivoted and started a photography studio in the San Francisco Bay Area. So that was a pretty big change, but I took everything I had learned about business, and I had a master's at this point, an MBA with an MS in information systems, and I applied it to opening my own business and running my own business. So I ran a photography studio for 18 years, specializing in children. I love babies. I love children. I'm a newborn baby whisperer. I am obsessed with people, photography was a great outlet for me because it allowed me to do the art science thing, because photography is actually very technical with the lighting and all that stuff, but you have to be in the moment with people and be able to reach in and, bring them out so that they expose their true self to you. So my light's going to go in and out. So then what happened is I realized that I was doing very well in my business, but the taxes were eating me alive as an entrepreneur. And I realized that in order to solve that problem, I needed to go back to real estate on the side. And I started buying single family homes and doing that type of thing to control my taxes. In the process of doing that, I realized that even though I loved photography, I was basically owning a job. And so it was not scalable. And I realized what I really needed to do was pivot into being a full-time real estate investor. So I pivoted my third time, or fourth time if you count my stage acting as a child, my fourth time into being a full-time real estate investor. And in the process of doing that, I gave myself 5 years to really learn and educate myself and exit my studio and start doing it. So what happened is doing a lot of education, met Neil Bawa when he was teaching a boot camp. I went to his boot camp, and that was about year 4, started volunteering for him as an analyst and underwriter. Didn't realize he was basically interviewing people because he was transitioning companies, and started working for him full time, closed my studio, and within about 6 months was the vice president of the company. So it was a kind of a very fast progression, but I was at the 4-year point of major career pivot that I was pouring my heart into. So it was a lot of hard work that got me there. And again, I was kind of going back to my family roots. My father's an architect, my dad, as a developer. So lots of experience in general that just kind of brought it all around. And I guess if it wasn't for me, my baby, having a baby as a single parent, I wouldn't have buckled down so quickly and had that tech career that really launched me into the technical world. So, and for that, I'm going to go on, and I don't usually give that whole backstory unless I'm talking to a group of women, because I want everybody to know that anybody can achieve, 2,000 units and do all this. It's like everybody can do it. You just bring everything that you are to the game. And women, we're such multitaskers, and we're so capable that we have so much to offer in this arena. And with that, we're going to go on to talking about asset management. I'm not going to go too much through this portfolio. So best practices for asset management. So what I'm going to cover today is, first, where do you start? How do you start figuring out what to do with your asset management? The first thing we're going to do is we're going to talk about onboarding the property for asset management. And then we're going to talk about what you're going to require from your property manager on a weekly basis, on a monthly basis, and then on a yearly basis. So what's your property manager, you're going to drive your property manager to give you these things. From there, we're going to talk about the asset manager, what you need to be doing, and then also talk about investor communications. And then we'll go into the next stage, which is dealing with asset management in times of Corona, and the offense and defensive moves that I recommend. So asset management all starts with a business plan. We all know, we're all multifamily people. We all know that multifamily is a business. And so where do you get your business plan for your asset management? Well, it is the final underwriting of the property. So when you underwrote the property, or somebody on your team underwrote the property, they had assumptions. They came up with a budget for the income and a budget for the expenses. Hopefully you were working with an experienced property manager in the area that was helping you really hone in on the income and the expenses. And you created a projected net operating income that this business was going to deliver in order for you to make certain returns. Within that is an expected unit turn rate per month. So in order to achieve that NOI, how many units were you going to be turning per month? And what was the expected rent bump that you were going to try to get in order, again, to meet your business plan? And then you'll have a budget for your interior and your exterior CapEx. So boom, that's where it all starts. Now, your property manager, there's a bunch of characters. Many of you might be like, yeah, I know all these people, but I just want to kind of name them for some of you that might be newer to them. So you have your local property manager who's, if you've got a large enough property, that is, this is a full-time person that's on your property. Usually it's about 80 units or above, depends on the market you're in, but your budget supports a full-time local property manager, as well as typically a maintenance person. And then above the local property manager, you have a regional property manager. This person usually takes care of multiple properties in the area. So you're not that person's only, but this is this person's kind of boss. You've got the maintenance manager, you've got the construction manager, sometimes it depends, an accounting manager. So the company should have, that the property manager should have some type of an accounting department. And then you have the person like way at the top, like the CEO, CFO, etc. So those are the characters. And you also need to make sure that you have your CPA. So once you're onboarding a property, you want to have already selected your CPA, and you want to make sure that the chart of accounts and the accounting method that your property manager is suggesting is approved by your CPA. So the property manager is going to basically develop a chart of accounts and put it into their software, their property management software. And you want to make sure right from the get-go that your CPA is good with the accounting, the separate accounts that you're using, and whether they're using accrual or cash-based method. So what we do next when we're onboarding the asset manager, the property manager, is we set up weekly meetings. So in these weekly meetings, I'm the asset manager, along with several of my partners. We often, where there's a group of us or a pack of us, and we are meeting with our local property manager as well as the regional property manager. Sometimes the repair person, the construction person is on as well. And what we do in those meetings is weekly basis, we review all of what we call trackers, which are Excel spreadsheets, or we actually use Google Sheets for this. So those are called trackers. And through these trackers, we're evaluating the data and the inputs for the property for that slice of time, that week. And we're all kind of getting on the same page. So that's the partner meeting. So this is important. So on a weekly basis, we have a partner meeting first, okay? All of the partners, only partners, are looking at all the trackers and getting on the same page. And then right after that, like 30 minutes for partner meeting, and then immediately after that, we have the partner plus the property management meeting. And we come into that meeting with a very focused group that we've already decided what we're going to talk about with the property manager. So we come in with a consistent message. So we're not ping-ponging all over the place. And in this property management meeting, we're going to review the trackers and set focus for the property manager. In addition, when you are onboarding a property, you want to establish your site visits, how often and who's going. You want to, I mentioned the property management software, so you want to know which software they have, and you want to make sure that you have a login to their software. You're going to need the login details. The other thing you're going to need is the bank account, and you want to make sure that as owners, you are on the bank account. So you need to be added to it. I've heard some people say that the property manager is on the bank account and they're not on the bank account. That's not the way we roll. You need to be on every bank account. Let's talk about trackers. So we're big data people. That's how we roll. And with all of our different properties, we have different property managers on every single property because our our assets are spread out across the United States. And even though some of them are in the same metro, even those ones happen to have different property managers because we're partnered with different people on those. And it just turns out we have different property managers on them. And coincidentally, with all those different property managers, there's a lot of different property management softwares that people can use. We actually don't have a single property manager that's using the same software as another one. So that could be a kind of chaos in terms of data, to be like, well, how are we going to understand the reports and translate the reports and get the data that we need? Well, what we do is we have the property manager fill out our trackers. So that's how we create the consistency that we need, so that all of our properties we're able to generate consistent reports and charts and trends, because they have to take their data out of their system and put it into our tracker. And I often get people, just like incredulous, like, I don't think my property manager will do that. And that's just the way we require, that's a requirement that we have of them. So once they understand that, when in the early meetings with the property manager, that it is a requirement, then they're okay with it and they get on board with it. So we tell them what our expectations are for the trackers that they're going to fill in weekly and monthly. We also onboard them to our technology. So besides our, obviously Google Trackers is just a Google sheet, but we also use property management software. There's lots of them out there, but you need to be able to track tasks and accountability to make sure things are on time. We use Asana, but there's a lot of good ones out there. You also need a communication mechanism. Besides email. Email will drive me nuts. Of course I use email, but I don't want all of my property communications going back and forth on email, because there's just too much of it. We are big slackers, huge slackers. So we create a Slack channel for the property manager and our partner team, as well as a partner only Slack channel. A lot of people use WhatsApp, which is very similar and also great, but I definitely recommend that you have a communication software that is encrypted and searchable and very specific to your process and your project. All right. So key pieces of asset management for multifamily. Here we go. So we're talking about the weekly reports, and the major thing that we have is on a weekly basis is the Monday morning report, known as the MMR. And this is our main Google sheet. And this one really scares the pants off of our property managers when they first see it, because it can be a little intimidating as a Google sheet. These are some of the trend charts that we create for all of our properties based on the data that's there. So you can see we've got, economic and physical occupancy charts. We've got net exposure. We're looking at delinquency versus economic vacancy. And we're very obsessed with our marketing efforts, our leads, appointment shows, applications, and leases. So the actual MMR, so we're going to talk about occupancy a little bit first. So you can see we've got our physical occupancy up here, and then our economic, and this is on a weekly basis. So you can see the trend here. The actual MMR looks something like this. It's of course larger than this. So this is only showing you about half of it. And the property manager is filling in basically all of the yellow areas. Okay. And so they're taking the information. This is important, that what they're doing is filling out a new tab each time. So the spreadsheet, when we look at it, has one tab for this current week, and then it has the tabs for all the previous weeks. So we can very quickly go back through trends and see what's going on. And as you can see, we can develop those charts by just compiling all the data that goes across all the weeks. But by having it all on separate little tabs, it's very, very useful. So they're filling in all the nuances, and I didn't capture all of the screens here. And when we teach it in boot camp, I show the whole thing and show all the stuff, but I'm just trying to roll through it a little faster here. But what we're focusing on is in the occupancy area, we're focusing on who's moving in, who's moving out, how many current evictions we have in play, the last week's previous leasing, okay, so previous lease vacants, previous leased NTVs or notice to vacates, people that haven't left your property yet, but they've told you they are going to be leaving. That's a notice to vacate. And then what is our total number of new leases that's come in for the week? So these are some of the things we're looking at related to occupancy. From a marketing standpoint, we break down not only, so we break down our traffic by leads, appointments, shows, applications, and leases. We want to understand each bucket that you can see here. And then we're also breaking it down by the source of the traffic. So we can understand which buckets are generating the most effective. And then we also establish what is the ratio between each of these things, so we can understand where we've got a problem. Maybe we've got lots of leads coming in, but we're not translating our shows into applications. So we might have a problem with a leasing agent that we need to address. So we're always looking at these ratios. Let's see. And then on the marketing, so here's our chart, for example, that is showing over time our leases, applications, shows, and leads. And we are also very focused in the financials area on collections. So what is the current month-to-date collections and the current month delinquent? This is 75%. This MMR was probably, you know, came at like, I don't know, the 4th of the month or the 5th of the month or something like that, because this is not a normal current month delinquent that we would see. But you definitely always need to be focused on your financials and your collections with your property manager. Always be drilling them on it. And that is one of the things that we are always going backwards through the tabs to find relevant other weeks that are about the same time of the month to compare financials, especially these days when we're focused on Corona and collections. We actually get way more specific with them, and they have to deliver on you know, sometimes some of them are delivering on a daily basis, others on a weekly, but they're telling us exactly what percent is collected. And we can talk more about that later. We are very focused on our evictions and skips. How many, current evictions and skips. So the current evictions that have been filed, as well as the previous evictions that are still in process. And then if we have any new skips. And then we also are looking at, you know, what is the schedule of move-ins and move-outs. You can see that in this little timeline, we've got 5 people that are scheduled to move out in 30+ days, and we have 7 total moving in. So we're always trying to understand our net exposure of where the property is and what's forward looking, not just what the occupancy is today, but looking forward, where are we trending? So all of this data comes together to help us see these things. And part of that, of course, is our service calls. So understanding how we're responding, how many we're getting, how many we're resolving, and how many might be left open. And then how our units are ready. So how many units are being turned, and how many units are ready to lease. Another very important thing. So lots of information that's on the MMR consolidated in one place. The next tracker that we look at on a weekly basis takes the concept of how many units have you turned and explodes that. Because what happens when we do our underwriting and we say, we're going to spend $6,000 a unit, and we're going to, it's going to give me $100 rent bump. And when you talk to your property manager, and they were maybe the ones that set that budget with you, and you said, well, how long is that going to take you to turn units for $6,000? And they said, oh, we can do that turn in 10 days. You said, great, that's really good. That's going to be great for us. We're just 10 days. But if you don't track it, you're going to find that 10 days starts leaking. And then if you really start looking at it, that 10 days can turn into 28, 32 days between tenants. And that $6,000 that they claimed starts leaking, and it turns into an average of $7,500 or $8,000. So without tracking and measuring exactly what they're doing on every unit, that's where things can start to go haywire. So we have our CapEx tracker, which tracking the exterior renovations, which is pretty straightforward. You have your exterior budget that you set, and then you're going to go through and kind of execute each of those plans. But the interior units is where you're going to really focus and make sure that the renovation package that was the budget is what they're doing. So there might be 3 or 4 different types of renovation packages. Of course, you're going to have a classic, because sometimes you're just turning a classic. Well, what's that going to cost you? There's going to be a budget that they establish for each type of turn that they're doing. And that's made up of various things. And then you hold them accountable in the CapEx tracker, so that every time they're doing the turn, they're actually typing in how much they spent. And then again, you can create the charts that are showing their performance. The other thing we're tracking is the move out date compared to the new lease signed. So if they're taking too long between move out to new lease signed, that's not a good thing. You're losing all kinds of money. But if you're keeping on top of it, see this move out date, they should be starting the reno. Like here's a reno here. Move out was 4/30. Reno start was May 20th. Based on that, as an asset manager, I would be saying, what is going on here? Why is this taking so long? Why did you not start this until May 20th? We'd much rather see, there's a lot of bad trends in here that you can see. So this is actually a good example. We want to see that they're prepared to execute their units right away. See this move out date, May 6th, reno start, May 6th. You betcha. That's what we want to see. So we want to see very tight turns in here. And then we want to, of course, track the new lease rate and the rent bumps that we're actually achieving. Not just that we said we were going to achieve in our underwriting, but what are we actually achieving? And then what is our return, our ROI from the renovation? So we've got our before reno rent, our after reno rent, our rent bump, and then our ROI from the return. And when you start tracking stuff like this and really get into the weeds with it, and you're able to develop these charts and these trends, you start to see some surprising things, because we've actually been able to pivot on our plans on a couple of our properties, because we were able to see that we weren't making the ROI that we thought we could make on a certain unit type. Maybe it was a 1-bedroom or a 2-bedroom. We weren't getting the rent bumps we thought we could get. They just, for whatever reason, wasn't happening. So we were spending the money, but not getting the rent bump. And then we realized, by doing a little bit of experimentation, that if instead of turning a premium on that unit, if we just did a classic with a pop, we were actually able to get a substantial rent bump that was substantial enough that our ROI was a lot better. So again, data and careful tracking of data and thoughtful attention to the data lets you look at what's happening to your property and make really good decisions about what you should be doing. Just because you have a plan doesn't mean you can't vary from that plan. You need to look at the data that's in front of you and pivot appropriately. So this is where we're measuring the actual cost, the time, and the rent bumps going across all of it. So CapEx can really catch you by surprise if you're not tracking it. And then all of a sudden you look at the account and you're like, oh my God, where did all my CapEx go? And the property manager's like, I don't know, we've just been turning units here. And so definitely need to keep close track of that CapEx. We talked about our project management. So we, in our regular weekly calls, we're going through all the project tasks, making sure that everybody's staying on top of things. That's definitely part of our weekly meetings. And then we talk about marketing in our weekly meetings. So we actually bring in our own leads. Our property managers, of course, have leads that they do. Typically, it's some kind of process where they kind of add a button into their AppFolio or whatever they're using, and it generates out leads from that, kind of a built-in service. And they might have an additional service they use as well. But what we do is we have an offshore team that's part of our virtual army, the Efficiency Center, and they generate lots of leads for the property. so many leads that the property can't even process them. And we actually process those leads too, the email, the Facebook Marketplace, and the text messages, all of that, to turn those leads into appointments that are booked at the property. And then the property manager does the showings of those appointments. So this is where the slack is happening between the CSRs, our call center people, and the property managers. So using technology to generate tons of leads, and then using technology to, of course, communicate across multiple time zones. Now, on a monthly basis, we do our financials. So of course, your property manager is delivering your financials, but what should you do? Should you just take those financials and say, thank you very much? Well, we boil it down and we make sure that we're looking at budget versus actual. So for everything that they establish, because your property manager is going to establish a budget, then we say, what did you actually do for that? And then for each line item, whether it's a good variance or a bad variance, the property manager needs to document why they're off. Why, if it's a good thing, we want to do more of it. If it's a bad thing, we need to they need to tell us why, what's going on here? Why are we low on this? What, so that we can nip things in the bud. It's holding your property manager accountable, line item by line item. Let me see if I got all of that. Yep, number of units, turns. Yep, we got that. So we have a financial meeting every month, and we bring in our CFO. She's an independent consultant, Loretta, and she, her superpower is just scouring financial reports, and she just can see the data like nobody's business, and see all kinds of trends that are happening. She makes sure that everything ties out everywhere. She'll see something and she'll tell her property manager, and this is when they bring in their accounting department, because Loretta asks very, very dense, deep questions. And so the accounting department's there on that monthly meeting, and she's saying, I need an initial report here. I need to see all of the underlying transactions here. This number's off here. I'm not liking this trend here. So having that level of accountability really puts your property managers on their toes, because I think they just realize that it's going to be pretty hard to get one over on us. The other thing that Loretta really helps us do is make sure that everything, in a great way for the property manager too, is to make sure everything is in the right bucket. Because if you are going through the year doing your finances, and this could be your property manager or you, whoever's doing them, and you're not putting them in the right bucket, and then at the end of the year, you have this financial spaghetti that you're giving to your CPA, and you don't even realize it because that's not your superpower. Well, that can be very expensive, because the CPA then has to go through and spend a lot of time clearing things up. So Loretta helps us keep everything in order. She knows all of the current tax laws and the current structure that's required. So she'll be like, no, this is in the wrong place. We need to move that under here because the tax change of blah, blah, blah requires this and that. And this label should be like that. Otherwise, it's going to confuse your CPA. So it's definitely very helpful to have that expertise on your team. On a monthly basis, we also require our property manager to present a rent survey. So they're going to secret shop the competition. It's typically the same 4 properties that are established from the beginning. So they're just reshopping those and seeing if there's anybody new on the block, right? They might add in a new one if that is true. And they're looking at the classic versus renovated pricing. They're also looking at the cost of amenities, the cost of fees, like, and then do they have any new concessions? Are they giving any specials for rent? And then other income, are they charging pet rent? What's their price for rubs? So all of that information we look at on a monthly basis. They present it to us, and we are kind of scouring the landscape. So let's talk about what the asset manager needs to do. We believe that we need to stay on top of the market, and we're in a bunch of markets, but we need to stay on top of the market for jobs, for population. We need to always be looking out for new businesses, business closures, changes in the law, things that are local politics that are going on, and of course, incoming supply. So we need to understand if there's a new multifamily being built down the block, how that, when it's coming online, and how that could affect us. So you definitely have a responsibility to stay on top of these things. And your property manager hopefully is helping you keep aware of this. But you can simply, set Google alerts for the metros that you're in so that, you're getting all this type of news on a regular basis. The other thing that the asset manager should do, in my opinion, on a monthly basis, once you've got those financials, is have an NOI tracker. So it's very simple. It's a net operating income tracker, which is basically, I have it on a monthly basis. So I'm breaking down my projected underwriting. So I have my original underwriting that said, what am I going to do? So this is the NOI that that the property is projected to make on a monthly basis throughout the hold. And then I'm just plugging in what is the actual NOI that the property did. So I'm saying, here's what, I'm the asset manager, but I'm responsible for the business plan. Here's what we said we were going to do, and here's what we are doing. So that way we're able to really quickly see, are we on track or are we off track? Because it all comes down to the net operating income. It's very enlightening to keep track of this. And then year-end financials, we've got, of course, your year-end financials from your CPA. And then, as I mentioned before, you need to vet them throughout the year. And then you will be producing your K1s, which should be to your investors, if you have investors, by March, so that they don't get really pissed off at you by end of March. When you are doing your site visits, what should you be doing? So one of the things that we like to do, besides taking photos and videos, and we do a lot, some kind of on-site like material that we roll up for our investor updates, we also recommend that you're always auditing. So whatever you're hearing on the phone, you should always be testing when you're there. Find something to test. Never trust, always validate. So this is your number one job as an asset manager, is always to be validating the financials and proving the things that they said. So you're going to be doing spot audits, and every time you go, you can do a different spot audit. Some of the things you can look at the payroll. Okay, so hey, we've got the payroll report. You need to be talking to all of the people that are on site and getting their names and making sure those are the names that line up with the payroll, and that you meet everybody on site. And so if there's somebody named, George, that is always on the payroll, but you're on site and you're like, hey, where's George? They're like, George? There's no George that works here. Well, that's a way that they can get over on you, is by having an extra payroll person that slipped in. Another thing that you can audit is the appliances. So you can get the serial numbers for the appliances that were put into the renovated units and go and actually check that those are the serial numbers on the appliances that are in there. Repairs and maintenance receipts. So you'll have the tools that were purchased. You want to make sure that those tools are actually in the tool shed. So each time you go, you can kind of create a different bucket that you're going to research to validate what they're saying. And it really will help your property manager know that you are all about it, and they will be less likely to try and get over on you. Now, for investor reporting on a monthly basis, what we do is we provide an investor update via email, and it goes over, occupancy and delinquency, unit turns, any special projects we're doing. We also include a market report, and then guidance on financials. I don't know if this is actually going to pull anything up. Oh, yeah, there you go. So this is an example. We produced it out of our active campaign. This is a value add that we purchased. This is the old model unit. This has all been completely redone now. This is when we this was our remodeling. So it's pretty extensive. We've got our market update, our guidance on financials. So this is an example of our investor update. And then on a quarterly basis with investor reporting, we are providing the financials to the investor. So the financials are included as a link on the investor update. Typically, it's the T12 and the rent roll at a minimum. Some of our projects are providing what's called an owner's report. So the property manager provides a much more comprehensive report. We love those property managers, and it includes the just all kinds of stuff in it. Very, very well done. The other thing we also do on a quarterly basis is we do a webinar with our investors. So we've just given them the financials, and then about 10 days later, so right after the first of the month, we do a live webinar where we are presenting the financials to them, budget versus actual. So now we have to face our investors and say, here's what we told you we were going to do. Here's what we're doing. Here's our actual activity. And just like our property manager had to give us the budget versus actual like variances, we're doing the same thing now to our investors in full transparency, saying, here's how the property's doing, and here's where things are going well, here's where we're off track, here's what we're doing to get back on track. And it keeps us very honest, because every one quarter goes like that, and in no time you're going to be back in front of your investors. And then once you present the budget versus actual numbers, then they're asking live questions. And so nothing like keeping the asset manager honest than being in front of investors. And then investor reporting yearly. Remember to get those K1s out. Now, what happens if you are off track, or you sense you're going to be off track, or something might happen, like say a pandemic might hit? We believe that you need to increase your communication to your investors. So in that case, we turn on the knob that we call Chatty Cathy. So we begin to increase our communication to those investors. We add additional videos. Instead of once a month, we might be sending out twice a month. And then we also can add an additional webinar or additional email. So if things are off track, it could just be that you're off track on a timeline or something. I mean, pandemics don't happen all the time, but this is also a good example. But we feel that it's very important to always be very transparent with your investors and get ahead of the communications instead of recoiling back and getting no crickets, Chatty Cathy. And then with that, our next section, what time is it now, is to go over how to protect your communities and your investors' profits related to Corona. So I wanted to potentially take a couple questions before I go into that. I see that I've got, so what strategy can you use for a property manager that hasn't responded well enough to providing metrics and KPIs? So that's from Vivian. Vivian, the strategy I would use with a property manager that is not responding well enough is, again, in my onboarding, I've already told them how important it is to me. We had a property manager that didn't respond well to our metrics and KPI requirements, and we replaced them. So we don't, if I don't have the data I need to do my job as an asset manager, I can't do my job. And if the property manager is not going to do that job for me, then I am going to replace the property manager with a company that is. There are companies out there that will. There's companies out there that believe you need the data that you need. So that's my honest answer. You might want to work with them to try and get them to understand. You might want to spend some extra time training them so they understand how to use your trackers. If you can't get them on board, change your property manager. Paige is asking that I live in California, and how do I handle managing an out-of-state asset? Yes, Paige, all of our assets are out of state. We would not be, we don't invest in California, and with all the craziness going on with these, rent control and a 25% decrease during Corona times, that all these things that are going on, we won't be in California anytime soon. So we are a completely virtual company. Neil and I like to say that we are basically a tech company masquerading as a real estate company. Everything we do is virtual. So what advice do I have for newbies looking to get started but struggle with the unimpressive NOI in California? I think you need to get out of California, Paige. There is a lot of not good things happening in California. It's not a landlord-friendly state. You're going to have a lot of problems with evictions. If they happen, people will be staying in your property for a year, 9 months. I think you need to develop strategies to be looking at nearby states that are drivable, that are better. So we just don't invest in California. Let's see, what is the difference between economic and physical occupancy? So physical occupancy is the physical people that are butts in seats. So how many units are physically occupied? Economic occupancy is how many of those butts are paying me money. So just because somebody's in my unit doesn't mean that they are paying me money. They might be on eviction, thus they are have not paid for, depending on the state, it could be 2 months trying to get them out, or 3 months. Now I want to make sure that you know that there are times when tenants go under hard times and they need help. So there are things like payment plans and promise to pay programs, and we'll talk about those in Corona. But when I'm explaining the difference between economic and physical, it's really as simple as that. It's the people that are not paying you. They're in your property, but not paying you. So I might have a physical occupancy of 95%. So I'm 95% full, but 10% of them aren't paying me. So I only have an economic occupancy of 85%. And that's what really matters to the bottom line, to my net operating income, because that's my revenue coming in. So I always need to try and limit the difference between my physical occupancy and my economic occupancy. I want them as tight as possible. So I'm collecting as much money as possible. The more money I'm not collecting, the more damage it is to my net operating income and my business plan. Remember that business plan? My business plan is not going to do well with a low economic occupancy. Do I give a probation period to my property manager? We give them, definitely try to work with them to get them on board. I mean, we do a lot of very, very heavy vetting of them in the first place, but to make sure we're picking the right ones, because it's painful to change property managers. But I don't think we give the probation period. When you start, we would only give them 6 months. I guess I would say this: if they're not working out, we'll give them a few months, try and train them. And max we will go is 6 months. And that second 3 months is the time that we're actually looking for the next property manager to vet the new property manager. So I would say there'd only be a 6-month period that we would have a property manager before changing. Okay, so I'm going to now talk about asset management. We're about Corona. So very challenging time to be a property manager and an asset manager, but so far, I would actually have to say, so far so good. So these slides were actually put together in, I would say, late March, when there was a lot of unknowns, but the information is still all valid. So we have our offensive strategies and our defensive strategies. So for each project, we are assessing, you need to assess the community's health on a regular basis. So including daily monitoring of COVID-19 cases, you need to understand if you've got sick people on the property. We also provide a lot of research to our residents so that they know what their options are in case they contract COVID-19, and they know what the steps are to take. We look at whether there's certain buildings that are more at risk for spread than other units. That's something we need to be aware of. We provide residential services. So we did a lot of research. Again, our offshore team, our virtual army, did a lot of research to find the resources for each property, the neighborhood, city, county, state, and federal resources for food and health care and childcare and just like all kinds of services, and provided that to them as a live link PDF so that they would have easy access to information that could help them in lots of different ways. And then we reach out to residents to update them and with a list of services, and also to understand their needs. So that's the property managers doing a lot of that talking. We need to understand the tenant risk profiles. So and from that perspective, we're talking about two things. So risk profiles can be a health thing. So people that are at risk because of their health situation, or people that are at risk because of their employment situation, because they're restaurant workers and they're at risk economically, as opposed to, I mean, we're all at risk in terms of health, right? But the people that are more at risk of losing their job because of where they work. And then the suggested remedies to tenants might be in the economic health stance, helping them to know where to apply for unemployment, making sure they have the links for that. And then of course, we already talked about the health perspective. Evaluating at-risk tenants. We're looking at the rent roll to understand as best possible. We don't necessarily have 100% perfect information, but we're trying to understand what percentage of our populations across our different properties are in at-risk industries like airlines, restaurants, hospitality, travel, and entertainment. And online leasing. So we have created video tours and posted them online and Facebook and websites. So we've gotten really good at having the property manager walk through, slowly walk through with their phone turned horizontally. And then we take that footage and we add music and add little labels and make it look really schmancy. So that has really helped us. So lots of online leasing protocols, and of course, providing more payment options. We don't necessarily want the drop box happening anymore. Certain classes of apartment buildings, people tend to do less online payments, and for some reason they want to bring in money orders and some stuff like that. So we're trying to incentivize people to do online payments, and so there's less contact going on overall, and transfer them to that over time and not go back. And then lots of online marketing. So we have physical leasing. Of course, the traffic went down for a while. It's actually coming back up because the states we're in have reopened. But virtual tours are still super popular, and it's a great way to pull people in. So even if your property, where your property is now opening back up, those virtual tours are great marketing pieces. Maintain occupancy. So you want to increase or maintain occupancy. We thought this was going to be an issue, and you'd think it would be, right? You think a pandemic's coming, you might have people leave, but nobody's going to be moving in. Let me tell you, that has not been the case. We have had huge amounts of people, like 6-7 leases a week coming into some of our properties. All I can say is I feel like some people aren't happy with who they're sheltering in place with, and they're like, I'm out of here. I need to get my own place. Because we're just so surprised. Our apartments are like 98% occupied. So I don't know. And then of course, the other part of that is people that were leaving, the notice to vacates, the NTVs, many of those people have stayed. So that is keeping our occupancy up too, because they were like, I thought I was going to leave, but now things are uncertain, and so I'm gonna stay. And then they might translate to month, or we might translate them to a different type of lease, so that we can see how their situation goes. So reevaluate the prior notice to vacate. Some of them you want to get them to stay, and some of them you'd really rather they leave because you weren't happy with them as a tenant. So you might want those ones to just go to like a month-to-month status. And the ones that you were like, oh, really, we want you to stay with us, maybe set up a lease with those ones that were actually good tenants that you want to stay. Okay, so prevent and assist with delinquencies. So we talked a little about, we've got lease modification programs. There's lots of different creative strategies out there that you can find out about on the internet. But I would say that most of what we've been doing is basically P2P, promise to pay. So creating payment programs with that are just the tenant working individually with each one to understand their situation and their needs and when their money's coming in, and creating timelines that they can responsibly come back in with that money. That's been most of what we're doing. We're also doing a lot of incentive programs depending on the property, because we're in different neighborhoods and we're Class C's and Class B's. Some of what we've done is $50 off cards if you pay your rent on time, available to everybody. So if your rent is early or paid by the 1st, you get a $50 off card, which is pretty cool. And we've had a lot of people bring in their rent early. We had one program that did the $75 off if you paid early, and then potentially $125 off for the next month. and if you paid that one early as well, so 2 months in one. And what we were trying to do there is saying, people are going to have a lot of stimulus cash coming in. In this population, we believe they would have the unemployment checks, which were going to be healthy, plus the stimulus checks. Some people would be getting a $6,000 check, which for them was a big deal in their household. And so we were trying to encourage them to invest that money in rent. And I would say that it was a good experiment. Only one person took the 2-month route, but in general, the collections across all of our properties have been very strong. The B-class properties, not surprisingly, stronger than the C. In fact, we have a B-class property that is 100% collection, so zero delinquency in time of Corona, which is remarkable, with no concessions used at all on that property. And then I think our other B was just like 3% off. But this month, so that was like last month, and then the C's were down, I think, an average of 9% between the two of them. One was worse than the other, which was dragging the other one down. All of the properties in terms of May collections are doing better than the April ones. So all of them so far doing better. I'll have more light in the sand drawn on May 20th. Now, defensive, social distancing. Well, we're all familiar with this. All of the leasing offices were closed, cancellation of resident events. All of the amenities were closed, no consumable goods in the offices, cleaning, lots and lots of cleaning, extra signage so people understood the protocols related to interacting with with people in the office, and then evaluating work orders for urgency. So none of the only urgent work orders are being done. If somebody needs a light bulb changed or something that's very simple, they provide it outside the unit and ask the person to do it themselves. If there is an urgent work order that needs to be done, then the tenants are asked to go into a different room, and the workers go in with, like, full PPE equipment on to actually do the urgent work order. Now, what about unit turns? Well, we stopped our renovations, our premium renovations on certain properties, most of our properties actually, for the first month, and then said, no, we're going to save our CapEx. So unit turns is only going to be classic, no premium renovations. That we did do premium renovations on the properties that have a bridge loan, and the draws are coming from the bank. So it's like, we've got to spend this money anyway. We're in the middle of stabilizing that property. We're only 2 months in. So we continued churning on that one so that we could continue with our plan. So each project was a little different. And I think that's kind of how you have to approach it. You need to look at your loan and see how your CapEx is set up. You have to look at your property. You have to understand how well capitalized you are. But we did, for example, on one property, we stopped the unit turns, went to only classic. That's the one that was 100% collectible, and now they're at 99% occupied with 100% pre-leased. But so the one unit that's pre-leased, we're like, make it a premium renovation. These people they don't even realize that Corona is going on here. This property is amazing. So each property really needs to be evaluated, again, using what? Using your data, because you've got all your data in your CapEx tracker. You've got all your data in your MMR. So you can make good decisions because you know your trends. Capital preservation is very important during a pandemic like this. So we are withholding distributions from investors. That was communicated to them in their investor update. And then we're also withholding payments to us of asset management fees. So we're not getting paid anything either. And then we, of course, are reducing or removing all non-essential expenses. Once we go to, sorry, one more note on this. Once there is a crisis like this going on for a property or, a whole nation, as we are in, the job of the asset manager turns. You were responsible for creating wealth before. Now you're responsible for capital preservation. You need to preserve your investors' capital at all costs. And if that means stopping distributions, stopping this, stopping that, that is your job. No longer, you have the excuse to say, I couldn't pursue that business plan anymore. I had to preserve your capital. So we had to cut back on unit turns, and we had to pivot because there's a pandemic. It's okay to say that, but that is your job right now. Delinquencies and financials. So you're increasing lots of focus on delinquencies, right? I think that's pretty clear. I am going to ask if there's any other questions. Let's see. let's see. How did you determine, let's see, how did you determine which properties were at risk for spread? Curious on the characteristics of the building or something. Well, it's more of a concept versus anything that we actually discovered on our property, but we definitely did we had people consider it. Like, was there anything in the HVAC, like people that were sharing air, for example? Is there anything about any of the units that are coupled in a way that that would be conducive to spreading germs? It could be a railing that's shared between two units. So you need to evaluate where you could have cross-contamination between two units. Maria is asking if I've ever used 3D photography to create virtual tours of properties since COVID-19. Not yet, because everything was shut down. So we just had our property managers walking through with their phones because that's what we had. But we are looking to get some better photography in there because we do really like the virtual tours have been very popular. So we are going to continue pressing that. Regarding rent collection and my portfolio, are there certain classes, A, B, C, being impacted more or less? So C is definitely more impacted than B. All of our A classes are under construction right now, so I can't compare that. But the B was very, as I said before, was hardly impacted at all and is looking to be done even better this month. So I think that we'll have barely any impact on the B, if anything. And C, I would still expect to see probably a 7 to 9% impact. Again, there's one property that's dragging the other C down a little bit. So, but probably overall it's better. May collections are better than April, so they're going to be better. Can I also speak on closing and managing development projects during this time? Sure. So our development projects are going gangbusters. So we invest in, okay, Neil and I, blue-blooded people, Democrats, but we don't invest in blue states. We invest in red states because red states are business friendly. And in those red states where we've been investing intentionally, when the new construction that's going on was deemed essential for all of those states. Not too much of a surprise, right? So all of our construction was going on, no problem. There was definitely protocols that were asked to be put in place. So that's no problem. They have certain hand washing stations and maintain certain distance. But we've ramped up our construction on those projects during that time and been able to turn things even faster because there's more construction labor coming into the market. People are coming from states that shut down construction into states where construction is still available. So instead of 2 framing crews on a site, we would have 4 framing crews just throwing that stuff up. So construction has been going very well. Non-essential expenses, pest control, I don't consider non-essential. Landscaping, we have been continuing as well. Neither one of those did we cut. So we are looking at trimming as much as we can. We'd be looking at instead of cutting pest control and landscaping, we'd be looking at going to the vendor and renegotiating their bid is what we'd be doing. But we wouldn't be looking to cut the service. Curious if we've written into leases something about payment expectancy. No, we don't write the leases. I haven't heard of that property managers doing that. I think the recording is going to be available. Yes. Okay, well, that's the question so far. And I just wanted to talk quickly about how we are looking at projects in this time. So I'm going to move into Grow Capitus and the way we look at projects. This is a shorter period we're almost done, but I just want you guys to know how you can pivot and still get projects in this era. So pre-corona, we already had seen that the multifamily industry was really being squeezed. The juice was being squeezed out of it. And it was really hard to find good deals, especially value add. We already were doing new construction, but we were like, we need to pivot and look at new niches, at new markets, at new things. What is the next thing? And so we came up with a list of things we were looking for pre-corona. We wanted projects that had higher resilience. We wanted multiple exit options. So instead of, when you buy a big apartment building, there is only one way to exit, sell the whole apartment building. So we wanted projects where we could sell off in different ways. And I'll give you an example of that in a minute. We also wanted projects that were attractive to many, many different types of buyers, not just groups of people that could raise large amounts of money. We also were looking at multi-purpose projects, so different types of rental flexibility, students, corporate travelers, families, just higher resilience. And then we were looking at rapid execution. Remember, we're doing quite a bit of new construction, about half our portfolio is new construction. We wanted to be able to get quicker from the new construction to cash flow. So shorter timelines and faster cash flow. And that could be applicable on a value add too. If you're doing a heavy lift value add, basically, how do you get to that cash flow faster? Unique differentiators, we wanted to have a compelling story for investors and tenants. And then, importantly, we're looking for ways to productize. We're looking for things that we can productize. So we basically are rinse and repeat. We do a project, we rinse, we repeat. So this was all pre-corona. This was all January that we were pivoting in this way. And then Corona hit and we're like, oh, these things all make total sense for investing in the time of Corona. These are all good things to look for in projects as we move forward. And then right as Corona hit, we have new debt challenges, right? As you all know, it's very hard to get debt right now. Interest rates are rock bottom, but especially for value add, they've got these new escrows that you've got to do. There's all kinds of issues with it. New construction actually is a great way to go right now. And we're getting quoted new construction loans at 4.75%, 3 years IO. I mean, some crazy low new construction loans. 4.75 is crazy low for new construction. For those of you that are used to value add, typically we hear about 6.5% as being low for new construction. So 4.75 is unheard of. But they don't have the same requirements that Fannie and Freddie have that are throwing up all these roadblocks. New construction, as you're building it, is going to be around 12 months from now, you're going to start leasing. And at that time, we're in a much different world than we are now. So our first project that we put out during the pandemic, and we didn't know how it was going to go, but we sold it out. It was a $3 million raise. It's 32 units, so 2 16-plexes. And specifically, they're 4-plexes. It's 8 4-plexes. And the benefit of that is that we're able to sell them off individually to different owners. And again, this is already sold out, so I'm not trying to sell you guys on it. It is a 506C, but it's all done. I'm using this as an example of a project that we were able to successfully raise money on with no problem, because it addressed the mindset of investors. First of all, the loan was approved. We had a pre-approved loan, and it was the refreshed quote at 4.75. So no issues with debt. The project has wellness real estate in it, which is pretty crazy that our developer partners already planned this into it. They are partnered with Delos, which is like an internal air filtering and water filtration system and lighting system. So the inside of the units are all controlled by this really cool panel. So that's, of course, going to be very, very attractive. Optimized amenities. So it's small boutique buildings, no elevators, no pools, very compelling in a post-COVID world. Flexible exit options, lots of ways to exit at different times, and lots of pools of buyers. So these are 4-plexes. Oh, and by the way, it's in an opportunity zone, okay? So we can sell to opportunity zone people coming in at certificate of occupancy that want to use their OZ money. You can buy from a developer at certificate of occupancy, buy it then, and it counts as your OZ money, and your gains are golden. We can get 1031 money, people that want a 1031 and buy a 4-plex. Obviously, there's REITs that could come in. It's right next to University of Houston, so you can have families that are buying a 4-plex that want their kid to go to school there, so their kid's going to live in one unit with their friends, And then the other 3 units are going to basically pay for that kid's rent for the 4 years. So anyway, lots and lots of exit options and potential buyers, and then an experienced team. So I just want you to see, this was, I know the question's probably going to come up about underwriting. Like, how do you underwrite how do you underwrite exits during Corona? Well, here's how we did it. We said we want to be able to project lots of different holds. We don't know what's going to happen. No one knows what's going to happen. But here's a 12-month hold. We can sell off the whole project in 12 months at certificate of occupancy if that's the right time to sell. And we had this exit cap rate of 5.6. So if Houston, pre-Corona, these would have been at 4.75. So 4.6, 4.75. So almost that's a pretty large joint up. So if it was above 5.6, well, hey, we wouldn't sell at 12 months. We would hold on to them. So this is what it would be if we sold at 24 months. So again, at 5.6. Well, if that wasn't the right time to sell because the cap rates weren't right, then we could refinance and hold for 5 years. And this is what the return would be. But here's a return that we thought was extremely compelling. The biggest challenge these days in an investor's mind is debt, because first of all, that's hard to get, but we already described that we're able to get debt with a new construction. But more importantly, if your tenants aren't paying you rent, who's going to pay your mortgage? So that's the big fear of real estate investing right now, is your mortgage. It's the biggest piece of your pie. So we came up with an option with a 5-year hold with no debt. So what we do is we sell 3 of the 8 fourplexes at certificate of occupancy, pay off the construction loan, and hold the remainder debt-free for the 5 years. So the break-even occupancy in that scenario is 27%. So that's I've never seen a break-even occupancy as low as that. But by creating a flexible project that had multiple options that were completely reasonable, given the pivot ability of this particular property, that it's in an OZ, that you can 1031 into it, that you can sell multiple parcels off very easily. This is a great way to consider looking at projects as you're looking at them. You want flexibility, you want the ability to pivot, and in terms of, you want a lot of different hold times that make sense. And that way you can say, what's your exit cap rate? Well, this is the exit cap rate that we would sell at. Well, what happens if you don't have that exit cap rate here? We hold, we go on. What happens if you don't have it here? We hold, we go on. So this, I think, as an underwriter, worked very well. It also worked very well for the investor mindset, because again, we sold out the property very quickly. And also we have already pre-sold 4 of these fourplexes. So we already have achieved, before we closed we just closed the project, and bought the land and all last week. We already had pre-sold 4 of these fourplexes. So investors definitely were very engaged and compelled with our strategy and our approach during this time. People want to invest money, especially in things that are not the stock market right now. Things like this that are much more tangible. You definitely have the ability to raise money pursuing this type of thing. So with that, I'm so sorry. I think I've taken a lot of time, but we did answer a lot of questions along the way. And I'm happy to answer more questions now. I'm not sure if Maria, let's see, I can stop share and we can go to just screenshot. How's that? Okay. So Maria, do you still want me to define wellness real estate?
No, I got it. I
Okay.
typed that question a little bit before. Thank you.
I know, it's like you can't like take it off after you wrote it. So any other questions? I'm sorry, I guess I took a long time to go through all of that stuff, but we did have some questions along the way.
No, that was great, Anna. I know I took a lot from that, and I'm sure everybody else did. I feel like I got a behind-the-scenes glimpse at how growth capitalist works, and I've always wanted that, so that was really cool. Now that kind of dangled a carrot for your boot camp that I'm definitely going to look into now. That was great. I think there was a few other questions in the chat. I know I had some, but I think you answered pretty much all of mine, so I think the time might be better spent if any of you ladies have any questions, you can unmute yourselves and speak up.
Christine, over here in Miami, what areas are you looking for opportunities on, and what's like your minimum like footprint if you were to look at other development sites? Is it just opportunity zones, or is it?
Oh, no. It's not just opportunity zones. That one happened to be an opportunity zone, and that definitely gives you a leg up, right?
For sure.
I would say, so we're looking to, we like that the quadplex is very flexible, and that gives us the ability to productize that we were talking about. So we're looking for kind of urban infill lots. The ones that we're in, I think it's like 3/4 acres. There's 2 3/4 acre ones. So it could be an acre, it could be a little less. And then, we're very specific about cities. So we're interested in cities that are tech oriented and medically oriented. Schools are good. If it's close to schools, we like that as well, like universities, but it's got to have a lot more than just universities. And then we always apply population and job metrics. I actually have let's see, I just wanted to share, let's see, where is it? There was an interesting article that just came out. I'm going to share it over here.
Do you favor, I mean, obviously you're in the West Coast, so you probably favor that area more, or are you?
Absolutely not.
No?
No, we are in Atlanta. We've got 4 properties in Georgia. We've got a few in Utah. We've got 2 in Arizona, 1 in Florida, 1 in Texas, 1 in New York. No, we don't favor California at all. We're more about the Southeast. So this is a Forbes article that just came out about, best cities to invest in post-corona. I think it just came out today. And so the 10 cities, and this is alphabetically sorted. Of these, we're invested in Provo, Salt Lake City, Tucson, and Raleigh-Durham, which is, Durham and Raleigh are like in one. So these are cities that they say are going to do better afterwards. But using data, we had already picked these cities pre-corona, because not every one of these cities, but the ones that we picked, because corona is kind of wiping the playing field. It's kind of taking cities, taking businesses, taking things and that were kind of teetering, and those are the ones that are not doing well. We intentionally invest in cities that have strong population growth, strong job growth, where all the jobs are going, where all the tech workers are going, because those environments have more cushion. When things happen, bad things happen, whether it's to a small city or a city or at a nationwide level, any place that has more of a cushion is going to have the ability to recover faster. And I think this list really proves it. When Neil and I got this list today, someone sent this to us. We were like, wow, we have so many cities in this top list. And then these other ones like Boise, we've been trying to get into Boise, but haven't been able to. And then if you look at these the bottom 10, sorry, Miami, but you're in here. This is more about corona. But it's also cities that, a lot of these cities are, Detroit, Michigan is not doing well, and financially, Los Angeles, I think it's been overpriced, and now it's got a terrible problem with corona. But anyway, if you're using data to make decisions, this just reinforces it all for me, that as you go forward, then you'll be in the best situation you can.
Great. Thank you very much.
And I've got a question for you. So I love that multiple exit strategy scenarios that you drew up. Is that not something that you guys were doing prior? So is this kind of a way to splice the deals?
Yeah. So what's really different about this, first of all, it's much smaller deal, and that's the other thing we're doing. We wanted smaller deals, right? The new construction faster, 9 months new construction done, quick to cash. But because it's parceled as it's 8 fourplexes that we can sell off individually, you can't do that when you're building a 200 unit apartment building. That's not an option to sell off different units. And then factor on top of that the OZ. And then here's another really key thing about the debt related to quadplexes. people that are trying to get debt to buy a large building from you, we don't know what the debt landscape is. It's going to be very challenging. But people that are getting residential debt, there's no problem with residential debt right now. You can get, because a fourplex and smaller is residential debt, right? You can buy home loans are very cheap and very easy to get. So we're tapping into an easier stream for people to purchase from. And that was actually one thing I forgot to say in the presentation, which is very, very important, is the source of debt for your buyers, right?
Excellent.
So it's a whole strategy. It's kind of like, Hey, Lisa. Look at all these lovely ladies.
I'll ask you a quick question, Anna. When you're going over and analyzing all of that data, and it's so much data to put into charts and everything, do you have your team of VAs help with that, trained on that? Or what does the behind the scenes look like to compile all of that? Because it's so much.
Yeah, absolutely. Remember, I'm a process geek. I'm a data geek, but I'm a process geek. So first of all, the property manager is putting most of it in place. But then there's pieces like generating the charts that require moving data over into the right places so the charts populate. That's the virtual assistants that do that. But yeah, I mean, anything that's a repeatable process, that I'll create the process and document it with like a video or something, and then I hand it off to somebody else to do, so I can go work on other things. But I need to be able to see the data in trends. We want to see trends. We don't want to have to go and just look at this mishmash of data and be like, oh gosh, what am I going to do with that? So yes, we leverage the virtual assistants. The property managers first.
It's Lisa. Sorry, I couldn't unmute myself quick enough earlier.
Sure.
Great info. Thank you so much for sharing everything. I loved all of the systems and data and the property manager holding them accountable. That's a big thing. I mean, very few operators, I think, are going to go to that much, time and detail to check in. I like those spot audits. Great information there. So lots and lots of golden nuggets in this one. We appreciate you coming on.
Good. I'm glad. We use our portfolio as a thing to experiment. We're always trying. I mean, both Neil and I are process geeks, so we're always trying to improve. And by tracking the data related to everything we're doing, we actually have metrics that we can compare to say, did we actually improve it, or did that process we introduced just cost extra time? So, they don't call them the mad scientists for nothing,
Yeah, very impressive.
Yeah, but I'm actually the one behind the scenes doing all the work, just so y'all know.
That's what I mean. You're very impressive.
I heard someone mention you have a boot camp coming up soon.
Yeah, we do a quarterly boot camp. It was supposed to be in Seattle, which is really funny. The last one was in Atlanta. It was a physical boot camp, which we've gone to doing physical boot camps. So we started out doing virtual boot camps, e-boot camps. That's where I met Neil, was at an e-boot camp that he was teaching. And then we started, and it was pretty funny. Like, I started teaching part of the boot camp, which was really funny. But so now I've developed parts of the boot camp myself. So we were teaching live once a year and doing e-boot camps. And the live boot camps were just like, these are so awesome. We need to do them all the time. So we started doing that, and then Corona hits, and we're like, we're not doing a live boot camp in Seattle. Like, no one's going to come. So we're like, okay, we're going back to virtual. So yes, it's June 1st through the 4th, and then then following this, Monday through Thursday, 2 weeks in a row. 5 to 7 p.m. is the time frame, but honestly, it's going to go to 8, so it's like 3 hours. And there's different modules. I teach asset management as well as underwriting, and Neil teaches a lot of other stuff. And you can the boot camp. Let's see. If you go to www.multifamilyu.com. Here, I'll type the multifamilyu.com/boot camp. So the price actually just went up there's a super early bird price, and I think it just ended a couple days ago. So now there's the early bird price. And sorry, I don't know exactly what it is. I'm not in the marketing department. I don't set the prices. But you can look online there, and I believe I can offer you guys a discount for anyone that wants to use it in this group. I can offer you a discount code for $300 off. So if you email me, if you're interested, you can email me and I'll give you that discount code just for this group, because they'll like check the people's names and stuff, because we can't just be giving like $300 off to everybody, because it's so you would get the $300 off plus the early bird. So it's pretty good savings just for you girls.
That's awesome. Thank you so much.
Yeah.
Are you sharing like your contact info, or how do people get in touch with you through Candace?
Sure.
Hey, don't do it. Don't do it live. We'll do it.
Okay.
Yeah.
Perfect.
Because the recording goes out publicly, so I just don't want I don't want you
Yeah.
getting bombarded.
Perfect. Thank you.
But we can post it in the women's Facebook group.
Good.
Sorry. Sorry
Thank
to
you.
interject on that one.
Yeah, no, good.
Any other questions before we wrap it up?
Hi, it's me. This is Chat. I
Hey,
just
Kat.
wanted to, I don't have any questions because your presentation was very thorough. Thank you so very much. But I have known you for quite a while now, Anna, and I've known about you and heard about you. Your reputation is so awesome. And so I just want to thank you so much for sharing a very, very special part of your story, which you
You're
said
welcome.
never shared. And I so appreciate that by you sharing it in our group. And thank you so much. We really appreciate that, Anna.
You're welcome. I mean, when I'm speaking on podcasts and stuff, I don't usually say like, yeah, I was a teenage single parent. I mean, I was on welfare, everything, going to UC Berkeley. I mean, it's like, how is that relevant to a lot of people? But when I'm speaking to a group of women, I think it's very relevant that people know, like what made me who I am today. Yeah, it's because I was a single parent on welfare. Yeah. And, I had to, then went through and got my master's. My daughter was with me in my classes, as I was getting my master's degree. And that's what gives you grit,
Yeah, for sure. Thank you so much.
Okay, well, I guess we will wrap it up for the night. I wish we could go on for another hour, honestly, because I could listen to this stuff all day. But thank you, Anna, so much for joining us. That was
thanks everybody. Here, I'm gonna get a quick snap of everybody.
Okay.
Smile. There you go.
All right. Well, I hope everyone has a great night, and please join us next month for our June MWM that we'll be announcing shortly, probably within the next week or two.
Thanks, everybody. Glad to meet you. Glad to hang out with you.
Thank
Thank
you.
you, Anna.
Bye.
Good night.
Thanks.